Right now, we're witnessing a massive structural macroeconomic shift across North America. I mean, it's literally being driven by the explosive power demands of artificial intelligence, massive data centers, and this sweeping wave of electrification. And sitting right smack in the middle of this thrilling market narrative, Capital Power Corporation. But here's the catch, right? As focused investors, we absolutely cannot afford to just buy into a cool story. We have to buy the numbers. So, welcome to today's Explainer, where we're going to put those numbers under the microscope.
So, we need to answer one very specific question today. Is Capital Power actually powered up, or is it completely overpriced? When a narrative gets this loud, the market has a really bad habit of getting way ahead of itself, and that often leaves everyday investors holding the bag. Today, we're acting as financial detectives. We're going to separate the massive market hype surrounding this energy stock from the cold, hard, mathematical reality of its balance sheet. Let's see if it's actually worth your hard-earned money.
All right, here is our roadmap for today's explainer. First up, we'll meet Capital Power Corporation. Then we'll dive into the bull case for CPX. Third, we'll uncover some red flags and heavy debt. Fourth, we'll calculate the intrinsic value. And finally, we'll wrap up with the final verdict.
Okay, Section 1. Let's meet Capital Power Corporation and get a clear picture of exactly what they do.
So, originating from a century-old municipal utility up in Edmonton, Capital Power has been aggressively expanding its footprint. They now boast over 9,000 megawatts of capacity across North America. And to put that into perspective, that is a massive amount of juice flowing into the grid. Lately, they've been busy snapping up major U.S. assets, places like La Paloma and Harquahala. But what's even more impressive is how they've executed their landmark Genesee Repowering project. By aggressively transitioning away from coal, they're actually slashing 3.4 million tons of CO2 every single year. That is absolutely crucial for their long-term viability and keeping up with modern ESG mandates.
And this right here? This brings us to the core of the market hype. We are looking at a powerful, long-term structural tailwind. Look, AI data centers are just power-hungry behemoths. Combine that with the booming build-out of North American electrification, and suddenly the grid needs massive, unprecedented amounts of reliable baseload power. Reliable electricity is rapidly becoming one of the most valuable commodities in the entire tech sector. And Capital Power? Well, they're generating exactly what the modern digital economy is absolutely desperate to buy.
Moving on to Section 2, the bull case for CPX. Let's see how this all translates into actual fundamental growth.
Make no mistake, the operational execution here is undeniable. The company hit a massive record of $1.58 billion in adjusted EBITDA for 2025. Now, you really have to contextualize that number. For a huge, typically slow-moving utility company, achieving an 18% increase, double-digit EBITDA growth is absolutely massive. It proves that their strategic shift into cleaner, long-term contracted power is actually translating into real, bottom-line results on the income statement.
Now, I want you to pay close attention to this metric, AFFO, or Adjusted Funds from Operations. If you look at standard free cash flow for a highly capital-intensive utility, honestly, it almost always looks terrible, right? Because they are constantly spending billions just to build and acquire infrastructure. That's exactly why AFFO is basically the holy grail metric for cash generation in this specific sector. It measures the true cash coming from core operations. And for Capital Power, this critical health metric is up a staggering 29% year over year.
Wow. But here's where things get complicated. We are looking at a fundamental tug-of-war. On one side, you've got incredible earnings momentum and a very healthy 3.8% dividend yield that's been growing 6 to 7% annually. Fantastic, right? But pitted directly against that strong operational arm is a really heavy anvil, staggering debt levels, and severe shareholder dilution. It's this intense clash between operational growth and extreme financial leverage, and that brings us right to the risks.
Section 3, red flags and heavy debt. It's time to pull back the curtain on the bear case hiding inside the ledger. When you look at the cold hard math on this balance sheet, it is incredibly stretched. They're carrying nearly $6.8 billion in net debt. But look at that return on invested capital, the ROIC. It's sitting at just 2.18%. That is incredibly low, especially when you consider how expensive their debt is. Compounding this whole situation is an interest coverage ratio of only 1.24x. That leaves virtually zero buffer for any kind of earnings shock. Essentially, almost all of their operating profit is being devoured just to service their debt.
So you might be wondering, how exactly do you pay for an aggressive $3.5 billion acquisition cycle when your debt is already pretty much maxed out? Well, you issue new shares. In just 1 year, they expanded their shares outstanding by 16.71%, raising $1.1 billion in equity. Think about that. A 16.71% expansion means your slice of the ownership pie just got significantly smaller. That massive erosion of per-share value means these shiny new acquisitions absolutely must perform flawlessly just to justify watering down the stock.
If the late, great Charlie Munger were looking at this setup, we imagine he'd face a classic value investor dilemma. He would undoubtedly appreciate the essential services nature of this utility, and for sure the reliability of its long-term contracts. But looking at that mountain of debt and a debt-to-EBITDA ratio over 7 times, it would probably prompt this exact hypothetical sentiment. It's a perfectly fine business, but it's a balance sheet that commands extreme caution at the current price.
Section 4. Calculating the intrinsic value. Let's dive into the climax of our financial detective work and crunch these numbers. First up, we look at the PEG ratio. This is a metric the legendary investor Peter Lynch absolutely loved to use. It takes the standard price-to-earnings multiple and adjusts it to account for both the company's growth rate and its dividend yield. Now, in a perfect world, Peter Lynch wanted to see this ratio at 1.0 or below. That means the growth and yield perfectly justify the stock price. Capital Power currently sits at 1.46. So what does this all mean? It indicates the stock is modestly overvalued, meaning you are definitely paying a premium today for future growth.
To find the true fair value, we have to weight multiple models together, because standard discounted cash flows just don't work perfectly for heavily indebted utilities. It's like a giant puzzle. We use a dividend discount model, or DDM, for the future dividends, and a standard DCF for cash flows. However, as you can see, we place the heaviest 70% weighting on enterprise value to EBITDA and AFFO multiples. Why? Specifically to account for that massive debt load we just talked about. Blending all these together, we calculate a fair weighted intrinsic value of exactly $63 per share.
Of course, intrinsic value isn't static. It's dynamic based on market conditions. If we see a big drop in power prices or sudden interest rate hikes, we plunge down to a $42 bear case. Our base case, assuming steady growth and stable prices, lands at $63. But hey, if they manage to secure a major AI power purchase agreement and aggressively pay down that balance sheet, we rocket all the way up to an $88 bull case. The value here depends entirely on which of these catalysts actually materialize.
And here is where the reality check hits us. The current stock price sits highly elevated at exactly $73. So the market is already pricing in a very significant amount of this AI and electrification narrative. It's pushing the cost of entry an entire $10 above our $63 base intrinsic value. Basically, you are paying for the hype today, before the company has fully delivered on those much-needed balance sheet repairs.
And the math here is pretty sobering. If you want to actually achieve a standard market-beating 16-year 9% annual return, mathematically, based on current cash flows, you would need to buy in at $45.20. That is a stark contrast to today's $73 price tag. You are currently buying with a negative margin of safety. That means the stock literally has to perform absolutely flawlessly from here just to justify today's premium.
Which brings us to Section 5, the final verdict. Let's build all this data into a concrete, actionable game plan.
Look, the math is totally unforgiving when it comes to time horizons. If you have a short 5-year window, you might get lucky. You could hit a 9% return if that aggressive bull case plays out and the stock surges over $100. But over a long 16-year time frame, compounding math simply doesn't lie. Buying at today's $73 price is a mathematical trap for long-term value investors who are seeking high, predictable returns without taking on excessive risk. So based on everything we've uncovered today, here is your exact game plan. First, hold and collect that nice 3.8% dividend if you already own the stock cheap, say in the high 40s. Second, definitely do not initiate a new buy at $73. Third, if you are holding, start to trim your position to lock in some gains if the price hits that $80 to $85 mark. And finally, sell all and head for the exits entirely if their debt to EBITDA ever exceeds 8 times or if they are forced to cut that dividend.
Bottom line, Capital Power is a solid company riding a fantastic macro wave. But at today's price, the balance sheet risk heavily outweighs the reward for new buyers. Yes, the AI revolution absolutely needs power, but are you willing to overpay for the power plant? Now that we've broken down the reality behind Capital Power, I want to hear from you. Tell us, which stock should we put under the microscope next? Let us know right down in the comments below.